once you have that and you have large custodians like the Boney Mellons of the world and the State Streets of the world that are building infrastructure in this space, they'll unlock the ability for large hedge funds or large allocators or large high net worth individuals that want to be able to post at the CME or for other types of ISDAs or whatever it is, tokenized versions of a similar asset that they're posting today. It's the fact that there's not a recognition from a regulatory standpoint that those two are equivalent, that's not permitted today, but eventually over time.
I'm here with Jim from Superstate, and today we're going to do an episode on RWAs. So RWAs is a kind of a buzzword, pretty hot topic, but we don't feel like there's been a lot of great coverage there. No one really diving deep into what are RWAs, what are some of the implications and the use cases, and we're going to try to tackle a lot of that today. So I'm Kinji, I'm an enterprise analyst here at Messari. Maybe we'll just go around, everyone can intro. We'll start with Jim and then move to Seth.
Yeah, thanks guys for having me on. I really appreciate it. So Jim, I'm one of the co-founders of Superstate. I run business development and I'm also a portfolio manager, co-PM on one of our strategies. Prior to that, spent about 2 years with Robert Leshner and the team over at Compound, helping build out some of the institutional sides of the protocol. And, my background was all TradFi before that. So excited to dive into this topic. As you mentioned, it's definitely been very top of mind for a lot of folks this year, whether that's coming from the crypto native community or traditional finance. Really, there's been a lot of momentum in the space. So excited to dive in and kind of share what we're up to and what we're seeing out in, the broader space as well.
Awesome. Like Kinji said, thank you, Jim, for joining us. I'm Seth Bloomberg. I work with Kinji on the enterprise team here at Messari doing research.
Sweet. Riveting intros. Before we dive into it, I guess I always like to assume that some listener just clicked on the podcast completely on accident. They have no idea any of the words we just said. So maybe to briefly set the scene, Jim, I'll go to you. Would you just want to give like a high level definition of how you think of an RWA or what is an RWA? And then maybe tagging on to that also, what are you building at Superstate to kind of get into that vertical?
Yeah, absolutely. Probably best to start with a little bit of historical context. So, blockchain-based systems historically had assets that were originated or created that were native to those networks, whether they were, governance tokens or gas tokens or other types of NFTs and things that are really crypto native types of assets that represent, some sort of utility for that ecosystem or for that protocol or for that network. When we talk about real world assets, we're talking about traditional, tangible, either goods or securities, things that are not native to being originated or created on a blockchain. The reason why they're really cool is because when you take a very old school instrument like a treasury bill or a fund or credit or equities or you name it, and you wrap it in a token in certain ways, you upgrade that asset to get blockchain superpowers. Transparency, that's instantaneous, that's 24/7. There's a whole bunch of things that we can dive into there. But fundamentally, what real world assets are taking things that are not native to on-chain ecosystems and bringing them on-chain so that you can do a lot more with them.
I think we'll definitely get deeper into the products as we go along. Now that we've kind of got the background out of the way, I think we can start to transition into some more of the nitty gritty, which I'm really excited about. People talk a lot about the growth of RWAs kind of over the last year, maybe 2 years. But if you actually start looking at the data, really all they're talking about is tokenized treasuries, right? That has been the driver of growth across the sector. That's also where you guys are kind of heavily involved with. I have a view that a lot of this growth was probably catalyzed by the on-chain or the spread between on-chain rates for stables and like the Fed funds rate. So during all the washout that you were talking about earlier, we saw on-chain rates fall below treasury rates. In my mind, there should be kind of some correlation between how those rates are happening and how tokenized treasuries are growing. I'm curious, I'm just an analyst, you're someone building in the space. Do you view it the same way? Or do you think there are completely different drivers that are kind of pushing capital into tokenized treasuries?
Yeah, it's a great question. I think the catalyst, for the inception of the growth on tokenized treasuries in particular over the last, call it, year and a half or 2 years really is exactly the story that you're talking about there. In a world of zero interest rates, when you go rewind the clock back not too long ago, but it feels like forever ago, to 2021, you would deposit cash in a bank account and you would get 25 basis points on checking accounts from, your, call it, favorite JP Morgan or Bank of America. And the delta between that and owning a treasury was basically zero. The opportunity cost, didn't make sense for you to really necessarily care about whether cash or treasuries was something that you should, think, or cash or money market funds was something that you should think about on a personal level or on a corporate level, on an institutional level. If you look at the blockchain-based ecosystem, a lot of folks were holding stablecoins at, call it, $100+ billion worth. When interest rates were zero, the delta between holding that USDC or Tether versus earning yield on it really, from a simple like risk-free perspective, was zero. By the way, during that time, as you have like the bull market in crypto, the interest rates on chain are, just like anywhere, is a factor of supply and demand for saving versus investing, for leverage versus liquidity. If you looked at Compound back in 2021 during the bull run, like you could earn 8+% on USDC. A lot of crypto native investors were like, hey, I can hold USDC or Tether and I can lend it to these markets and I can get paid a great amount of interest. And when I don't want to take that risk, if I'm somebody that's not as degen as that, for example, and they were just holding USDC in their wallet, the delta again was like nothing. Fast forward to like, the deleveraging in the crypto markets, as, at the same time the Fed was raising interest rates, that calculus for investors changed dramatically. When you were sitting on, $100 million of stable coins that you could earn 4% on all of a sudden without taking any protocol risk, versus the on-chain markets were now yielding like 4%. The equivalence between the two of those meant, that you were more, interested in lending your assets to the US government than it was to a DeFi protocol. And, we saw that happening, of course, and, there were some early projects that were launching, like Ondo, for example, was launching, their product to bring, treasuries on chain, which is kind of like the inception of a lot of the growth that's happened here. That has continued to play out, with the, as you mentioned, RWAs, a majority of what you see on chain, aside from all the work that like Figure is doing in the HELOC business and stablecoins, which are also very much real world assets. The securities world, I guess, with treasuries has grown tremendously just because of the opportunity cost. Now, I think that was the catalyst to get things started. But that's not necessarily the fundamental driver for future growth. I think it's obviously going to always be interesting for investors or imperative for investors to look at, whether they're holding something earning 0 or holding something that's earning 3% if the Fed lowers rates to 3. Like obviously the opportunity cost between those is still substantial. But it's the utility treasury bills that if you look at, even when in a zero interest rate world, it wasn't like zero people own treasury bills at 0% interest. There was still trillions and trillions and trillions of dollars in traditional capital markets holding treasury bills because it's like the best collateral on the planet. And so when you think about tokenizing those assets, institutional capital market that continues to develop, interest from our clients and from institutional traders or market makers or prime brokers or hedge funds or VCs is not just the yield that they can get, but it's also the quality and liquidity and speed of the collateral. And so my view is that the $2 billion sitting in tokenized treasuries right now it's great to see, but it's also tiny compared to, what traditional capital markets hold in treasury bills every day. And I think the gap between the two of those will compress, just given the fact that, as more institutions start to use blockchain-based systems to trade and borrow and lend and do other things, they'll want to have really high quality collateral, which is treasury bills underneath the hood. And so there will be a long-term bid underneath the, need for treasuries, given the use cases around them. And it's not just hey, I've got idle cash and I want to earn yield. It's a lot more than just that.
Okay, treasuries, perfect collateral asset, or very good collateral asset. In the long term, we see this kind of permeating throughout a lot of DeFi, a lot of crypto, just in general, because people want access to that sound collateral. I guess that's like a good long-term view. If we were to kind of shorten the time frame here, what type of use cases do you think you can go after right now, or maybe over the next like 2-year time frame?
Yeah, so it's a great question. I would say the first is just, we've already been doing it. It's on the bilateral OTC side. So there are a number of large institutions in the crypto space, call it FalconX, BitGo, Nonco, Arbelos, Flowdesk. Those are just to name a few of folks that, are doing sizable derivatives transactions or spot transactions where today they can use USTB as collateral or to settle those. And so we've been public on a bunch of those. So I encourage readers to go check those out. So I'd say that is first and foremost. The way that our products are designed is to facilitate peer-to-peer movement of the asset, whether it's settlement or collateral, subject to the investors being on an allow list of addresses. So yeah, it's relatively small. Like you have to start from zero first and get a community of participants. And this is how markets are built, where it starts, there's relatively low liquidity. And then all of a sudden, as liquidity starts to increase, the use case and utility of that is also exponential. But today, it's very bilateral. The second thing I think is still a very crypto native thing, but it's integrating these assets into DeFi. And there's kind of a few ways to do that. So one is, we take our experience from Compound, or we look at Morpho or Uniswap or Aave. Like these protocols are very efficient at launching permissionless pools. Given the securities world and the focus on regulatory compliance that we have at Superstate, and a number of our peers do as well, there's a architecture adjustment that's required from the protocol side to be able to still facilitate lending and borrowing and swapping, but ensure that that transaction still matches with the regulatory requirements from a securities space. So, for example, if I launch a pool where I'm going to take USTB or USCC, which is the two Superstate funds, and I want to post it as collateral, that smart contract has to be, whitelisted. And then the, person on the other side who's going to maybe swap for that asset, or maybe he's going to liquidate it if I get liquidated, they also need to be on the allow list of addresses. So that way, from like a regulatory standpoint, that transaction is still permitted, but, underneath the hood, like we can point to who the counterparties are on either side for attribution and compliance reasons. So that is possible today, but it's not a, just go launch a boosted yield pool and just like, farm a bunch of tokens because then you can, because you can launch this, without anybody's permission. Like that's not the case. And that's why RWAs are going to require, infrastructure to build around it. And then the third piece is moving into TradFi. And so, our team has been very focused on working with regulators. We submitted a prospectus to the SEC for our money fund to be able to register it as a security and sell it to anybody under the sun that is KYC'd and compliant. That's a process that will continue to work with the SEC. And then on the CFTC side, there's actually been a lot of progress underneath what's called the Global Markets Advisory Committee. And Commissioner Pham has been pushing this is to be able to treat tokenized assets as equivalent to traditional assets. And I think like once you have that and you have large custodians like the Boney Mellons of the world and the State Streets of the world that are building infrastructure in this space, they'll unlock the ability for large hedge funds or large allocators or large high net worth individuals that want to be able to post at the CME or for other types of ISDAs or whatever it is, tokenized versions of a similar asset that they're posting today. It's the fact that there's not a recognition from a regulatory standpoint that those two are equivalent, that's not permitted today, but eventually over time. So long story short, to go back to answer your question, is like this starts very small. It's OTC, it stays crypto native. You build out a lot of the use cases and the case studies around it so that you can demonstrate the efficiency and the utility of these opportunities. And then from there, then you start, to prove that out, not just theoretically, but like with tangible examples to larger regulators and institutions so that, that can proliferate in the regular capital markets. And eventually our view is it's just like, hey, at some point in time, somebody looked up and said, if we record this transaction, on a spreadsheet, it's probably better than a piece of paper that can get lost. That is kind of where we're at with this space. And like, all of us are kind of smirking at that, but like, it really wasn't that long ago when, physical records was how, I was actually in an Uber on the way home from the airport like a week ago. And I was talking to the driver and he said he remembers back in the 60s or 70s, like you'd have to wait a day or two to like go down to the, get your paper and then see what the price of the stocks were. And like, that's like insane to us to think about. But that really wasn't that long ago. Like my parents were born in the 60s.
So you're going through those kind of 3 use cases that you can see kind of incrementally growing over time. When I'm thinking of those, the underlying, I don't want to say underlying assumption, but they're all kind of reliant on there being sufficient liquidity for whatever the tokenized asset is. If liquidity is somewhat of a moat or a requirement, it kind of implies, at least in my head, that it's going to be somewhat of a winner take most category in terms of competition among tokenized treasuries. So, you don't want fragmented liquidity across like 15 different tokenized treasury products, which is probably around where we are right now. So how are you thinking about differentiation among these different products?
Yeah, so I would somewhat disagree with you on that. And the reason why is because if you point to traditional finance, like Fidelity, BlackRock, Wellington, Vanguard, Invesco, I mean, I could go on and on and on. They all have money market funds. While there's fragmentation to a certain extent, the reason why they have that is because they also offer other products and services to their investors and they're not just monoliths. And so I think the wrong way to view the tokenized treasury market right now, which I think is like it's very common the way that folks look at it, is that this is the only product that these companies are ever going to build. I think the truth of the matter is this is, because of all the reasons we just described, is a great place for these, asset managers, these like new age, what is going to be the next BlackRock are building, is starting with an area that there's a ton of demand and liquidity and use cases around. And then like there's going to be expansion from there, which is, why like we have our second product. And it took us 6 months to build the first product to get all the like right stuff built underneath the hood. And then it took us 6 weeks to launch our second fund. And now in the future, we're going to accelerate that timeline by using, the USTB Treasury bill use case as a way to, help build the foundation of our business. So then to answer your question, though, I think, fragmented liquidity and differentiation, like the fragmented liquidity is there today. That's correct. But I think, folks have different use cases or different jurisdictions or, different reasons for being in one product or another. So one is around, compliance and accessibility. There are a few products that only allow institutions, myself included. We can only take qualified purchasers from certain jurisdictions. And so if you're not in one of those jurisdictions or you're retail, unfortunately, I can't take you as an investor. Whereas some of the other issuers out there have the ability to go to that jurisdiction or down to retail. So there's, structural differences between legal entity or the openness for each particular product. The second thing is around fees and yield. There's a lot of similarities between a lot of these products, but then there's also a lot of differences. Some of the products rely solely on repos. Some of them have 2-week T-bills. Some of them have 30-day T-bills. Some of them have other agency securities in them. So there's like a wide spectrum underneath the hood that each investor has to kind of look at and figure out whether they care or not. I think one of the biggest differentiators, though, is what you hit on at the top, which is liquidity. And there's kind of 2 ways to look at liquidity. One is when I go to burn USDC at Circle, for example, if I have an account there, there's still, if I do that on Saturday at 4:00 in the afternoon, like presumably you got to wait until Monday to get your cash unless they have enough reserves, because there's still cash sitting in a bank account somewhere that they have to wire back to you. That is still the case for a lot of the like primary issuance and redemption for a number of the assets that are out there. And so I think there's ways that folks like ourselves and, BlackRock and Circle have a partnership, and, others have built, more instant liquidity, Hashnote, for example, with PayPal. Like, I give a lot of credit for a lot of these creative solutions that have been built with, credit lines, basically, that front the money to an investor and then they refill it back later. And, that provides more primary instant liquidity. I think on the secondary market, though, is where things become really interesting, which is, the having a DEX or some CeFi connectivity or market makers so that you're able to swap this as equivalent for another asset. Like if I want to go buy Bitcoin and I'm holding a bunch of USTB, I don't want to have to sell that USTB, get cash or stables back from Jim, and then go buy my Bitcoin from, Galaxy. Like I want to be able to go to Galaxy and say, hey, make me a market on BTC USTB, and like I'll pay you with this USTB, and then you can redeem that at a later date. And so that type of market structure, I think, is also part of the differentiation for these products. Certain ones that don't have compliance restrictions, like USTB does, have already proved that out. Like there's a lot of TVL that's going towards things like a Mountain Protocol that like you can go do USDM on DeFi, on Solana, or on Injective, or like other protocols that like Superstate might not be in. And that's because, they have more of a permissionless structure that they can launch in certain jurisdictions or on certain protocols. So yeah, there's a wide spectrum here. And I think everybody's also trying to figure out, how do I address the largest market without, putting myself in a position where you're spending all your time talking to lawyers, because, at some point in time, you have to like figure out where do you register and how do you structure it, and is it onshore versus offshore? And a lot of that is, unfortunately, the groundwork that has to get laid for this space. But once you get past that piece, then you kind of like focus on your TAM and you specialize in a particular area, and you just go build as much use case and utility on it as you possibly can. And that's been our focus.
Yeah, Jim, one maybe like naive question, but wanted to get your take on the concept of like privacy here. So you've been talking about working with like very large traditional financial institutions that have been using like their centralized spreadsheets kind of in the back office. And now you're launching these products on open public chains that anyone can go to, a block explorer and see what's going on. So is there a concern around that, or is that like a somewhat of like a solved business issue or technical issue, or how do you kind of handle that conversation with your customers?
Yeah, it's a really good question. And I think where we are building right now is open public network. So we're on Ethereum mainnet, is the only chain that we've launched on thus far. That being said, in the future, we do see ourselves launching our funds with tokens in other networks, whether they are L2s or L1s, they're private or not. There's, I think, going to be, depending on the demographics of clients, demand specifically for privacy. When it comes to our on-chain records, there's no PII or personally identifiable information or counterparty related information. Now, you could go, and you can right now, you can go to superstate.co/USTB. We have our contract address, our allow list address. You can see all of the details that are public on chain, but you don't necessarily know, address 1 is client A, address 2 is client B. So like there is anonymity associated with that, though, it is public that they are large institutions that hold those assets. Like it's just, you can figure that out. You can do that with any of the tokenized assets out there. So I think at some point in time, yeah, like there's going to be a need for issuing our products on more private networks. And as that technology continues to develop and the demand for that type of privacy continues to develop, we will absolutely do that so that, folks feel like they're protected. But, if you look at the traditional system today, it's all private to a large extent. You could see some information about, open interest or certain positions, but like there's really not real-time privacy. And that's, that's intentional to a certain extent. Like there's, there are reasons why you don't want to dox a large hedge fund that's building a position in a stock, because then everybody's going to see that. And, there might be downstream implications or negative if that transparency is there. But our view is, with the ability to see positions in a financial system minus the identifiable information is actually a much more robust capital markets. And, we're excited to kind of see that take place. But Ethereum might not be the place for that, or some protocol might not be the right place for that. And so, we will make sure that we're compatible in this other ecosystems.
You spoke a while back or earlier in this podcast about all these tokenized treasury protocols. They're not just going to do tokenized treasuries. They're going to start expanding into all these different products. Curious, I know you have like the carry trade product. Like we don't have to get super specific here, but what are some other opportunities that you think are interesting that you would see different RWA platforms kind of starting to explore?
Yeah, so it's a great question, and it's something that we think about quite a bit. If you look at the efficient frontier from like a risk and liquidity standpoint, treasury bills are at the bottom left corner of that. That's clearly where everybody started, and it depends on kind of how the client base continues to evolve. And I could see like maybe a couple of paths, but one of them being on the treasury management side, you've had a lot of protocols like Arbitrum for example, even Athena's reserve fund, like we won a mandate for both of those because they both were like, hey, we're sitting on either our native token in the Arbitrum world, or we're sitting on USDC or Tether in the Athena world. And they were like, you know what, we aren't managing our endowment, for lack of a better term, efficiently. And so we want exposure to highly liquid, high yielding assets, and that's T-bills. The next part of that evolution up that curve could be, things like our basis fund, which is daily liquidity, and it earns, 10% based off of where the markets are. And then it could be other traditional assets like investment grade, or maybe even longer duration treasuries or high yield credit. I think people have skipped over a lot of that and gone to private credit. And private credit is a broad term, but you see things on chain right now like lending to Latin American fintechs, which might have like a 9 to 10% or 9 to 15% projected yield, but if they have 12% loss rates, like that's not something that an endowment wants to stomach at that level of yield when you could get other comparable exposures for 9 to 10%, like what I just described. So I think like the treasury management piece could see, what's really cool there is like that's becoming more institutional. And so, just look at the balance sheet of a Coca-Cola or something, and you could see how they diversify their cash and liquidity needs based off of assets and liabilities and how they manage the two of those together. So that's one area. The second area is, and that's like bringing traditional world finance or asset management or treasury management to blockchain-based crypto native companies, protocols, you name it. The other one is, on the traditional world, there's a ton of demand to get exposure to crypto assets, but there's not a lot of direct participation from like large institutions. There's a lot of managers out there that have amazing strategies with like a systematic ARB strategy or some fund of fund strategy or some venture strategy. And, those have been successfully able to manage, to allocate capital or to raise capital. But I also think that there's like a number of investors that maybe want market neutral exposure, like more simple strategies, or maybe a constrained like passive index type of exposure. And so maybe those are crypto assets packaged up in a fund that are, available to traditional investors. So there's a wide gamut between the two of those different paths, but we're going to continue to just like, see where the market wants exposure, and we can wrap it up in one way or another.
Cool. So kind of seeing there's like these large pools of capital on chain and like DAOs and things like that, seeing what they want to demand, what type of RWAs they might want to park assets into. I think I'm in agreement that debt makes the most sense. Like, why would you take your treasury and throw it into some stock with Delta? Might as well grab some higher yielding things. And then on the flip side, we have institutions, traditional things that exist in the traditional world. They want exposure to all the cool things we are building on chain. And then you got to wrap those products for them as well. So kind of acting like as a two-way bridge, I think, in between both of these worlds, as opposed to, I think RWAs are typically seen as just pulling things from TradFi into DeFi. Whereas, there could be a more symbiotic relationship there.
Yeah. And like, actually what's interesting is that some of the RWAs are taking assets from crypto and moving them into TradFi. And then it's like almost the reverse bridge. That's not what we're trying to do. Like, what we're trying to do is take capital from the system and bring it on chain, exposure to assets that are on chain versus taking capital from, an on chain ecosystem and bringing it elsewhere and not having that, full loop back into, what can be used in, a compound or an Aave. So yeah, I mean, there's different approaches, and, some, have different views on kind of what the success of RWAs might be, but just wanted to clarify that, some of them have different ways of the flows of funds are maybe not going in the same direction.
I guess, is there anything that we didn't cover that you think, hey, if we're doing a podcast about RWAs, we have to talk about this and we didn't get to it?
Well, I would say, we touched upon a lot of the activity on the large asset manager side. I think that's like continuing to be really encouraging to see, but there's also a lot of like partnerships that are happening in crypto native land where you have issuers like Superstate working very closely with protocols that are just trying to like get into the weeds of figuring out exactly how do I scale, to address this protocol for a securities world. And I think that type of interaction is what's going to create the proliferation of RWAs or in the future, because I just keep going back to the fact that, you need to like have a reason why it's on chain. And it's like, yeah, getting uncorrelated yield or exposure to a particular asset is one, but then there's a whole bunch of other things that you can do. And so we're excited to continue to work like with some of the DeFi protocols that, have built new tools, and there's all these, curators that are out there that are continuing to like think about risk parameters around securities, and like, how do you create a market where you could use a treasury bill or a basis fund or real estate or whatever it is as collateral inside of one of these pools. And I think that's going to be a lot of where the market goes over the next 6 to 12 months, is to like really prove out that type of infrastructure. The other thing that I think is also lost quite a bit are what folks like Sky is doing. And Sky is the former maker. There's a $1 billion RFP that they're running right now for allocating capital to tokenized assets, and largely this is focused on, for now, this particular RFP is treasury bill exposure. But then there's a whole host of other things that I'm sure that the Spark and the Sky community want to get exposure to. And so what's exciting is seeing managers like Superstate and others that are bringing real sophistication from a counterparty standpoint, a lot of transparency and a lot of rigor to those products. And I think that to me, the more that the USDSs of the world work with the USTVs of the world, the stronger that both of these will be and create a much more robust DeFi ecosystem. Because now USDS, when it's going out and being used as collateral or being swapped or thrown around, even in the traditional world, there's real rigor in terms of the fundamental backing behind that product. There's a lot of confidence that can be created. I mean, underwriting that from like a risk standpoint becomes a lot easier when you know that reserves that it's being allocated into are really robust products like Superstate. I'm excited for that, as well as a number of others that just create a much more strong foundation for all of crypto.
I like it. Basically saying it's time for the industry to get their big boy pants on a little bit. All right, perfect. I think that's a good spot to end. So thanks for coming on, Jim.
Awesome. Thank you, guys.
Yeah, thanks, Jim. That was great.